Welcome back. In this video, we are going to understand what is a futures contract. In the next video, we are going to look at the options contract. For now, let's concentrate on the futures contract. A futures contract is a derivative instrument between two parties. In simple words, it is a financial contract or an agreement between two parties. One of the parties to this contract is the buyer and the other is the seller. By entering this contract, the two parties agree to transact a financial instrument, which may be a stock or a bond, or they may agree to transact a physical commodity for future delivery at a certain price. While the formal definition says that the contract is for delivery of a financial instrument or commodity, in reality, most of the contracts are settled by the way of cash instead of actual delivery. Let's understand all this in greater detail. The futures contract is a contract traded on exchanges just like a stock is traded. Buyers and sellers place their bid and offer prices, and the exchange electronically matches these orders and executes trades. So as far as actually executing trades is concerned, these contracts are not very different from what you are doing with stocks. What is different though is the nature of what you are buying or selling. Let's say a bread maker enters a contract with a farmer for supply of grains at a fixed price at the end of the month. Now the farmer is obliged to deliver him the grains at the end of the month, and the buyer will pay him the fixed price decided as per the contract. If during this period the price of the grain goes up, then the buyer is insulated from this change in price. This is essentially the essence of a future contract and how it works in case of a commodities futures contract. In case of stocks, the delivery of grains is just replaced by delivery of stocks, where the buyer of the contract is insulated from an increase in price of the stock during the period. Since the futures contract is a legal contract, everything is essentially specified in a standardized way in the contract. The exchange essentially specifies the various details of the contract. In case of stock futures, the exchange may specify the name of the stock to be delivered, the quantity of the stock to be delivered, and the date at which the stock would be delivered. While it is true that the parties to a futures contract may deliver the underlying security or commodity, in reality, it is not necessary that an actual delivery may take place. This is because there is an alternative available whereby the obligations of the contract can be fulfilled by the way of cash settlement. Let's say a buyer and a seller enter a futures contract on a stock at a price of $10. At the end of the month, the buyer agrees to buy 1,000 stocks from the seller at a price of $10. Now, if at the end of the month, the stock prices go up to 11, the buyer has benefited from the trade because he is going to be buying the stock at 10 while the same stock is trading at 11 in the market. One way for him to book his profits is by taking the delivery of stocks and selling the stock in the market at 11. This would lock him $1 profit on each stock, or effectively $1,000 profit on one futures contract. The seller of the contract in this case has a loss of $1. Now if he does not already own this stock, he would need to buy this stock from the market at $11 and deliver it to the buyer of the contract. This would result in $1 loss for him, or $1,000 loss on one futures contract. Now instead of going through this cumbersome process of taking the delivery and then selling the stock in the market, the two parties can settle the contract if the seller directly pays the buyer $1,000. This is what is known as cash settlement of contracts. In fact, most of the contracts in futures market are actually cash settled. As we saw in the last video, futures contracts have an advantage that you require less capital compared to the cash market for taking a similar sized position. But as we already said, this is a double-edged sword, as both your losses and profits are magnified due to leverage. With this, we have completed our discussion on futures contract. In the next video, we are going to look at the options contract.